In my analytical empirical work, what I set out to do was to develop a model of the Canadian economy, which I called low growth. I wasn't hiding my purpose in developing the model, but the model is quite capable of producing growth as well as low or no growth. And I used it to answer, or try to answer, the following question. Can we have full employment, no poverty, fiscal balance, and reduce greenhouse gas emissions without relying on economic growth? Now, just because we might be able to do it on a computer doesn't mean that we can do it in real life. There are some fundamental challenges ahead of us. But you'd be pleased to know that the answer to that question is positive. Yeah, you can do it. I mean, and I'll show you some simulations which give us that result. So let me just quickly summarize what makes an economy grow. Well, there are different ways of looking at that, but the way I adopted was really quite conventional as far as economists are concerned. It's got a lot to do with how we spend money. If we spend more money on consumption, it will show up as an increase in GDP, the standard measure of economic growth, which is what I work with for very deliberate purposes, because that's the language in which growth is discussed. If we spend more money on new equipment and buildings, so-called investment, the economy will grow. If government spends more on goods and services, again, that shows up in GDP, and the economy grows. And if we run a positive trade balance, that again makes the economy grow. That trade balance is increasing. You can also look at it from the supply side. What are we capable of producing? Well, if our labor force is increasing or becoming more productive, more skilled, then that will increase the capacity of the economy to grow. If we expand the capital stock of the economy through investment, the capacity of the economy to produce grows up and it grows. And then there's a whole host of things which affect productivity. Innovation, novelty, better organizational practice, and so on. And that also can influence the way the economy grows. And in low growth, all of those things are represented. So if you run the model and say, what would happen to the Canadian economy if it performed in the future, starting in 2005, pretty much as it had done in the previous 30 years, this is what it suggests. You get a steady increase in GDP per capita. You get greenhouse gases rising steadily, not as fast as GDP per capita, because of some efficiency gains. Unemployment goes up a little bit, comes down. The debt to GDP ratio declines. That was the track we were on before the recession. But the human poverty index, this is the UN's human poverty index, continues to rise, even with all that growth. More poor people in Canada at the end of it than at the beginning, more people, but that is not a very happy record, and that's with business as usual. Then I said, well, what would happen if we eliminated all of the growth drivers in the economy, starting in 2010, phased them out over 10 years? You'd expect it to be disastrous, and you get a disaster scenario out of low growth. Unemployment just goes off the map, poverty follows it, the debt to GDP ratio goes completely untenable. Eventually, the economy stabilizes. It's no growth, and greenhouse gases have come down somewhat. But this is a disaster. This is what scares people, scares me actually. This would be a terrible situation to work with. So the question is, can we do better? And I'm not the only person asking that question. Many are, including Larry Elliott, the economics editor of The Guardian, who raised this question in 2008, and was, of course, still asking it, and that's part of what we're here to do today. So you can certainly do better on the computer. Here's a scenario. Again, measures introduced in 2010, phased in over a 10-year period, leading to stable GDP per capita. Greenhouse gas emissions have come way down. Unemployment has come down below what it's been for the last 40 years. The human poverty index is very, very low, and still the debt to GDP ratio is looking very healthy. How does that happen? Well, it's a big story, but just to sketch out the answer, you have to always think about how you're going to manage macro demand and macro supply, the two things that come together to determine things like employment levels and capacity utilization. So the model sort of works out how to do that. The carbon price that I put in the model is useful for bringing down greenhouse gas emissions. You've got to have a carbon price, I think, to do that well. A shorter work week plays a key role in bringing the unemployment rate down, and more generous anti-poverty programs. That's trying to deal with adult illiteracy and to deal with longevity after 62 of the things that are in the human poverty index.